or the motivated central bank, the central bank originating the scheme, can hide behind another central bank through these swaps. Why this grotesque intervention in the currency markets should be secret is beyond me, except for manipulative purposes, and that's really the issue under our lawsuit.
If you're victorious in this in the early stages, Chris, I know Bloomberg won an early round and it's being appealed, right? Will, in the end, if you get high enough, is this just going to be labeled national security and shut down, most likely?
Well, let them do it. Let them do it in the open. Let them rig the gold market in the open. My problem with this is that it's public policy being conducted in secret. It is being conducted in secret through intermediaries so that the intermediaries can profit from that government policy at the expense of everyone else. When I was watching the one hearing in Reg Howe's lawsuit against the Bank for International Settlements and the Fed and the Treasury back around 2003, I was struck by one thing that was said by an assistant U.S. attorney in open court, and that is he said the government was not admitting the complaints made by Howe that it was involved in the rigging of the gold market, but the government was asserting the power to do so. That is, the U.S. government admitted in U.S. District Court in Boston during the Howe case that it claimed the power to rig the gold market, as Howe was complaining it had been doing. It just wasn't admitting whether it was doing it or not. My argument is, okay, you're the government. You can be a totalitarian government even if you want to, but what you are doing has to be done in the open when it comes to the markets. If you want to rig the gold price, you've got to let the public know that you're doing it. And in fact, governments for many, many years rigged the gold price. That's really what the gold standard was. It was a government policy that fixed the price of gold to very specific amounts of government currency. They used to do this in the open. Even as late as the London Gold Pool in 1968, the U.S. Treasury and the Bank of England openly rigged the gold price to $35 an ounce. Now they try to do it surreptitiously. It's the surreptitiousness really that is the surreptitiousness is really the most objectionable feature.
Gentlemen, paper currencies are a confidence game, as you know, and they only have value as long as people believe in them. When you look at these operations by the Fed and these other central banks, and I think I've always agreed with you gentlemen, you've got them red-handed here. They have to deny all the way to the end. But, I mean, in a way, is this what they have to do to maintain the confidence game, is my question for you.
It's all blowing up on them. Had they let gold trade freely, it kept pace with inflation. It'd be about $2,300. No big deal. But they're so used to doing this that they and sitting on the gold price, because as what Greenspan said, it's used as a thermometer of what's going on. If gold rallied $150 tomorrow, everybody would be screaming about something being wrong, inflation, crisis, something. Had they let it go and just take its natural course, well, so what? It would be trading $2,300, maybe go down to $2,200. It'd be no big deal. They've made it a big deal.
And Eric, they don't have to do this. They could just be disciplined and limit strictly the amount of dollars that are issued. If the supply of dollars was strictly controlled, the value of the dollar would be maintained. The problem is they want their cake and eat it. They want to issue unlimited amounts of currency, and they also want it to maintain its purchasing power. And that is where your statement comes in. Do they have to do this? Well, yeah, if they issue unlimited amounts of money, then they have to rig the gold market, and that's what they're doing.
No, I agree with Adrian. I mean, it's just what they do, and they've done it for so long under every administration since we started 11 years ago. It's just becoming part of the game, part of their policy, and now they've got themselves in a mess because they don't have the physical gold to meet demand. And I mean, the European central banks years ago were selling 400 and 500 tons a year, and now they're selling nothing. So it's a big hole to fill when it comes to where's the gold coming from, and they're running out.
Chris?
Well, the gold price suppression scheme, Eric, is part of a much bigger scheme to rig not only the gold price, but also the currency markets, the government bond markets, any interest rate related markets, and even the commodity markets generally. The British economist Peter Warburton back in 2001 wrote really the definitive essay on this subject, which you can still find on the Internet at the Gold Eagle Internet site. It was titled The Debasement of World Currency. It is inflation, but not as we know it. And Warburton suggested that derivatives, which were just coming into their own at that time, had been invented largely to divert investment money from real goods, oil, gold, any agricultural futures, things like that, to divert investment money out of real things and into financial paper purporting to represent those things, and to absorb the inflation of the world money supply into these paper instruments so that the general price level recognized around the world, consumer price indexes and things like that, would not rise. Derivatives were invented to siphon this excessive money creation into further financial instruments. This is much bigger than gold. It is really a manifestation of the age-old battle between the producing interests of the world and the financial interests. And the financial interests, as Adrian said, resent any discipline that the free gold price would impose on them. And so that's why gold is the focus of this worldwide commodity price suppression scheme.
And Eric, the moves by the CFTC to want to impose trading limits on futures is also another attempt at market rigging, which is under the guise of trying to prevent market manipulation. But essentially what they're suggesting is there should be limits on the long side of commodities. So they're trying to stop money, again, going into real things. Just as Chris was saying, derivatives were invented to siphon money into financial instruments instead of real commodities. Well, if you limit the amount of futures contracts people can hold, you're trying to do the same thing. So far, they're not suggesting any limits on the short side, so you can continue to manipulate markets and try and hold down prices of commodities.
Adrian, as you bring that up, it reminds me of the price controls that Nixon tried to put into place in the early 70s there that failed. And, of course, on the future side, they just began to trade above those, right? Is that what you think they're doing this in preparation for, is a big inflation, and so they need to limit the pressures they'll have against them on the commodities on the long side?
Yes, it's always a symptom of the start of inflation and then hyperinflation is that traders are blamed for driving up prices. Business people are blamed for raising prices. Workers are blamed for trying to get higher wages. And, of course, the last people to be blamed are those who are responsible, the government and the Federal Reserve, who are putting more money into the system, and its purchasing power is reducing, and that's why prices of things are going up. They try to impose controls to try and stop the free market forces of raising prices as the purchasing power of dollars reduces.
Eric, to give you a specific example on this topic, we mentioned earlier, Reg Howe put out a great piece yesterday that Chris said sued the gold cartel in 2001 and talked about this massive increase in derivatives or paper contracts and so on in gold. And these are quotes from what he just put out. In face of negligible lease rates and low spreads, the increase of 1,800 tons in gold forwards and swaps in the first half of 2009 is hard to explain in terms of traditional gold lending, prompting another query. Has the whole category of gold forward and swap, as reported by the BIS, now been severely infected by instruments that have no credible counterparty in the physical market? 1,800 tons is almost an entire year's gold supply. And there's some duplication here, and it gets a little complicated. But the point is, hedgers, which use derivatives, have been reducing their positions. That's well known. So how could you have this massive increase in this area when there's no other explanation? And what it's setting up is an explosion in the physical markets, and the paper markets will blow up.
Let me ask you something about that, Bill, and then I really want to get Chris and Adrian to comment on that Reg Howe piece. But for listeners globally, just so they can understand, if you're not having the hedging anymore, Bill, and you're having a hard time controlling the price, and you begin to increase these derivatives, as Reg Howe is suggesting, in the gold market to sort of artificially paper it down or control it, are you not setting up for problems in terms of physical, basically just running out on some of these markets? Meaning, we saw this, didn't we, Bill, when we got into the low 700s back in, say, October of 2008. Their buy orders were 99-1 over sell orders, and nobody could get any physical gold or silver, for that matter, for sometimes months, they were saying. I mean, is that, and then, of course, that alleviated as the price went back up, but is that what we're setting up for here, you're suggesting?
Yeah, the easiest one to see is silver with J.P. Morgan Chase. I mean,